kind of a variant on these other questions. How firm is the commitment to lower interest rates? And if things end up better, do you stick with these low interest rates as you projected them? Or is it specific points that you have in mind, for example, unemployment or inflation that is animating where you might go? And what are those numbers that you're looking for that might cause you to change about the policy as it now is
that's
projected?
where I would start. I would say, well, I think, we just had a period of unemployment, as you know, that was in the well below 4%, hanging around 3.5% that lasted 2 years. And during that period of time, we saw a lot of great things happening in the labor market, things that we'd love to get back to. We didn't see any problems with price inflation. Price inflation didn't really react much. So I would say, we'd be looking to get inflation back up, and we'd be prepared to tolerate pretty low, welcome, in fact, not tolerate, but welcome very low readings on unemployment, just based on what we saw in the last expansion. So, we're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time. I think most forecasters believe that. It would be great if we got a whole bunch more months of job creation like that. Notwithstanding that, as I mentioned, there are just a lot of people that are unemployed, and it seems quite likely that there'll be a significant group at the end of even after a lot of strong job growth that'll still be struggling to find jobs, and we'll still be providing strong accommodation for that.
James?
Thanks very much, Chair Powell. There have been plenty of comparisons with the Great Depression of the 1930s the crisis began. Is that scenario sort of that more dire scenario now goes out and we're looking at a more traditional and sudden recession? And are you at all concerned that the strong performance of the stock market in the last few weeks is disconnected from the economic reality?
I think that the Great Depression is a good example or a likely outcome or a model for what's happening here at all. I really don't. And there are just so many fundamental differences. First, the government response has been so fast and so forceful. The origin was quite different. This was an economy that was in a healthy place. Of course, every economy has longer run challenges. That includes our economy. Notwithstanding that, 50-year low in unemployment and the longest expansion in our history, and every reason to think it could continue. So that's different from what was happening around the time the Depression started. The financial system this time was in very good shape, much better capitalized. So, it's just not the right model. I would say we're learning, every month that passes, we're seeing more, we're learning more. And I think particularly the next few months will be very important in learning what the real story will be, because we'll see the significant incoming data about the opening of the economy, the reopening of the economy. And I would say, assuming that the disease remains or becomes pretty much under control, I think that what you see is a very weak second quarter, historically weak, and then an expansion that builds momentum over time. People will adjust probably a little bit gradually to some of the activities that involve getting together in large groups in close quarters. Those will be the harder parts of the economy to recover. But ultimately, we do see a full recovery over time, and that's really what what I think I'm personally seeing. And you could see significant job growth in coming months as people return to their jobs. But you're still going to face probably an extended period where it will be difficult for many people to find work, and that's what you see in really many forecasts at this point. That doesn't mean it's right, but that's sort of a broad expectation. Certainly not the Depression forecast. A broad expectation.
Chris from the Associated Press. Thank you, Chris from the Associated Press.
Hi, thanks for taking our questions. Well, in the projections you have, you didn't change, the Fed policymakers didn't change the forecast for long run that suggests that that all of you so far don't see necessarily prospects for long-term damage, but still, what kind of data are you looking at here to gauge, the potential for longer-term hit to the economy, even as we have something like the May jobs report? You could still have, at the same time people return from temporary layoffs, there could still be permanent job losses. So what kind of data are you looking at to gauge that potential impact, and what is it
this is a
telling
really
us so
important
far?
risk, and I think it's not the risk for the next few months, but it's the risk over time of lasting damage to the productive capacity of the United States, typically in two forms. One, through extended periods of unemployment. People lose contact with the labor force. They get out of touch with the skills that they need, and they have a hard time getting back in. And it's very damaging to people's lives and their working lives. And it also just lowers, in a way, it can increase the unemployment rate, but it can also lower the labor force participation rate, which is almost worse in a way, to have people dropping out of the labor force where we need them in the labor force working. The other piece of it is just businesses. A shock like this that just comes in, it's like a natural disaster. You wouldn't want a lot of perfectly good businesses, particularly the smaller and medium-sized businesses that may not have a lot of resources to sustain them, to go out of business permanently in a situation like this, where really there was no reason for it. Of course, businesses are going to go in and out of, they're going to fail all the time, and that's a healthy thing in capitalism. That's something that has to happen. But this is different. This is a way, potentially. So those are the things we've been worried about. We didn't change. You're right, though. We didn't change our longer run estimate of potential growth or of the unemployment rate. And that's, I would say, in my thinking, the reason I didn't change mine is that I think we can avoid that, or avoid much of that, most of that even. And we do that with measures that keep people in their homes, that support hiring, that support growth, that avoid unnecessary, avoidable business insolvencies. And that's all the things that we're trying to do. Basically, if you look at what's happened, as I mentioned, there's somewhere short of 25 million people have been displaced, even after the good May employment report. What we're trying to do is create an environment in which they have the best chance either to go back to their old job or to get a new job. That's kind of the most important part of this exercise. And maybe it's probably hopeful at this point to say that we won't have longer run damage to the economy and these numbers won't change. But I think it's way too early to be changing longer run. See, these are not meant to be short run numbers. They're longer run assessments. So I have not changed mine, and I'm hopeful that I won't have to change it. I'm hopeful that I won't have to change it.
Heather Long.
Hi, good afternoon, Chair Powell. I'm struggling with two things that I hope you can provide some clarity on. Is the ongoing bond buying program. You say that it's needed to continue the smooth functioning of markets, but I guess most of us aren't really seeing a lot of instability in markets right now. So if you could kind of give us some clarity of what you're seeing that needs to continue to be smooth at that level and that pace. Second is, you were just talking about Fed concerns about small and medium-sized companies going out of business during this. And I guess, the Main Street lending program still isn't running yet. When do you expect loans to start happening? And do you think the 2-month delay has hurt the chances of some companies surviving?
There have been gains in market function, although not fully back to where you would say they were, for example, in February before the pandemic arrived. We don't take those gains for granted, though. This is a highly fluid situation, and we're not taking those for granted. In addition, as I pointed out in my statement, those purchases are clearly also supporting highly accommodative financial conditions, and that's a good thing. So that's why we're doing that. Turning quickly to Main Street. So I would say that what we've done on Main Street, I think to a greater degree, is we've listened to feedback. So we've been out repeatedly for feedback in trying to create a much more difficult product than really the other facilities. And I think this this last set of changes we made have actually been very positive for the facility. I think it's going to be better able to achieve its goals. And, so we've used the time well, I think. And now we are now in the final run up to starting the facility. What we did, as you saw earlier, I guess it's early this week or late, whenever we did it, in the last few days, was we lowered the minimum loan size and we increased the maximum loan size. But I think even more importantly, we lengthened the maturity and we stretched out the repayment schedule significantly. So borrowers will get a 2-year delay until they have to make any principal payments, repayments, and a 1-year delay on interest. So we had been hearing from both borrowers and lenders that these would be very helpful. We made the changes. We're putting them through the facility. The next step will be to register lenders. At that time, loans can begin to be made. Shortly after that, the facility itself will be up, and those loans can be sold to 95% of the loans, and it's 95% across the board now in the Main Street facility, can be sold. So all of that should happen quickly now. And I do think this has been a challenging project, but I think we've come to a better place. And by the way, we're going to be prepared to adapt further if we need to, and that's true of all of our facilities. These are unique. There's no playbook here. You have to draw this up and then try it out. And we've been very willing to adapt, and we'll continue to be very willing to adapt, and we'll.
Okay, Matt from Bloomberg.
Hello, Chair Powell. This is Matthew Bosler with Bloomberg News. I wanted to ask you about regulatory forbearance. There were some piecemeal forbearance measures put into place in various jurisdictions and also to a slice of the mortgage market to prevent banks from foreclosing on such debts amid the widespread financial hardships caused by the pandemic. And with many of those set to expire soon and many businesses and households still in dire financial straits, I'm wondering if any consideration is being given at the Fed to more comprehensive regulatory forbearance measures or other regulatory measures to prevent businesses from going under just because they can't meet those payments. There have, of course, been some tweaks to the Paycheck Protection Program on the fiscal side to address this, but I wanted to ask you about things you might be able to do on the regulatory side as well. Thank you.
We can make changes to bank regulation and supervision. I don't know that we have the ability to make changes, for example, in mortgage payments, if that's what you're thinking of, or credit card payments. That's something that could be legislative, or it could just be what the banks themselves are doing. There's been a tremendous amount of forbearance on the part of the banks, and I guess our role there would be to encourage it. But those are not decisions that we hold any legal authority to make. And by the way, we have encouraged those decisions. I hope that's responsive to your question.
Scott Horsley, NPR.
Thank you, Mr. Chairman. I know you're loath to weigh in too heavily on fiscal policy, but given your forecast for elevated unemployment rates, do you think it's important that Congress extend the $100 per week extra unemployment benefit?
I think we try to keep our comments on fiscal policy at a high level, and I'll come to your specific question. But I would just say this. This is the biggest economic shock in the U.S. and in the world, really, in living memory. We went from the lowest level of unemployment in 50 years to the highest level in close to 90 years, and we did it in 2 months. Extraordinary. And appropriately, the response from fiscal authorities has been large, forceful, and very quick by the standards of these things. Roughly $3 trillion Congress has authorized, and that's benefiting households, laid-off workers, small, medium, and large businesses, hospitals, state and local governments. 14% of GDP. It's in a class by itself in terms of both the size and the speed of it. And it's also pretty innovative. Both the PPP and the unemployment insurance are quite innovative in the American context. And there were difficulties in implementing it, but that's really a function of their novelty, I think. Those programs, by the way, let me add, the Fed also, we both innovated and acted forcefully, progressively, proactively, and aggressively as well. You put those together, all of that is making a difference now. you look at the income data, the expanded unemployment insurance and also the stimulus checks have gone a long way to replacing lost income from job loss. I think you're seeing it in the job market data. Many are giving the PPP credit on that front and in keeping small businesses going. So so far, it's a good response and it's having a big effect. You get to the question is, it's big. Everyone can see that it's big. Is it going to be big enough? And that is a question. And the question the question that I've been concerned about really is this issue of longer run damage to the economy. We're doing a fair job of getting through these first few months, more than a fair job. The question though is that group of people who won't be able to go back to work quickly, what about them? And that could be many millions of people, who worked in parts of the economy that will be the slow ones to recover. And, we want those people back in the labor force. We want them getting jobs. So, and they're going to need, probably will need further support. So I would just say this, it's possible that we will need to do more, and it's possible that Congress will need to do more. In terms of the $600 unemployment insurance, I wouldn't try to give Congress advice on the specifics of that. I know they're looking at, I know from both talking to people and reading the papers that they're looking at a whole bunch of different possible approaches going forward, and some of those seem kind of promising. So, we're happy to give advice if people ask for it, but probably not publicly.
Thank you. David Gura.
Thank you, Chair Powell. I'm going to pick up on what Scott Horsley was asking just a moment ago. You have been studious about threading this needle in the interviews that you've given and speeches and the colloquy that's followed. Not giving advice to Congress, but indicating that there's likely to be a need for more fiscal stimulus or additional policy in the future. So I'm going to try a hypothetical here, and you can rebuff it if you want. But if you were to find yourself in a senator's office suite, he held up that May unemployment report, which you've described as unexpectedly positive and a welcome surprise. And if he or she said to you, look, this is an indication that we can put on the brakes, I wonder what you would say. Your message throughout this crisis has been one of how unprecedented it is, about how much urgency there is in dealing with this. Indeed, we've seen that from the Federal Reserve. I wonder if you worry that sense of urgency isn't being matched and what the consequences of that might be. If there's a fear that the Fed could be seen as a Cassandra here as we look at that unemployment report and then through the summer, and you have more and more politicians inclined just to wait and see what happens here in subsequent reports. And a quick second question, if I could. You've talked a lot about your fear about a second wave of this disease, and it strikes me there's a difficulty here with definition. You've talked about us weathering this crisis and getting through this storm. It seems to me as I listen to the chatter coming from the White House and from politicians and epidemiologists that there isn't agreement on what getting through this means. And you have an administration now inclined to, if not direct, be content with states opening up their economies perhaps too early. How problematic is that from a policy perspective, not having agreement on what it means to have defeated this virus or gotten to a place where the economy can stay still?
Advice, but I will provide a little context.
Okay, so I'm not going to give your...
I want to be clear about the picture. One way to look at the picture, really, and that is this: if you can get at this by looking at the widest measure of unemployment, of labor market slack, if you will, is the U6 measure. And that's the one we talk about all the time is called U3 by economists, and the one that has a much broader measurement of slack in the economy is U6. So in U6, the U6 level of unemployment has tripled from 7% to 21%. That amounts to 22 million additional people who've lost work in the economy, either by going to part-time or something like that. So that's in the low 20s, and that's post the May employment report. You can get at it a different way. You can look at just the regular unemployment rate. You can take the 21 people who were listed as unemployment now. You can add more on for the ones who were miscoded. You can also take those people who are suddenly out of the labor force. You put those together, and that has gone up by about 24 million. So those are two different measures of what's happened. So the question is 24 million people. Got to get them back to work. Somehow we got to all, as a country, get those people back to work. They didn't do anything wrong. This was a natural disaster. And I do think the responses so far have been great. So that's the way I would think about it. And if you think I would just, in terms of the May employment report, it's so nice to see. I mean, I think what people were thinking was that you'd start to get those back to work kind of numbers in June and July and August. Very few people saw them in May. I mean, almost no one saw that happening as early as mid-May, but it did. And so, and we don't know fully what that means, whether it's just a timing change or whether it will prove to be much more than that. We're going to have to wait and see. It is, as I mentioned earlier, it is clear evidence of just how uncertain things are and how humble we have to be about our ability to really have confident predictions as opposed to just predictions. So, bottom line, I would just say that is the key thing people need to understand, is that there's just a lot of work to do in the labor market. We're going to stick with this and support that until the work is done. That is something we're going to do with all of our tools, and I think it may require Congress to help as well. It may, but that's going to be their decision. You also asked about the second wave. Yeah, so we have major responsibilities and powerful tools, but the decision about when to reopen the economy is one for elected officials at the state and local and federal level. And, if they ask, we don't have any particular expertise here at the Fed in pandemics or coronaviruses or anything like that. We talk to experts, but, so we don't have anything special to add on that. I would just say it's kind of self-evident, I think, that if it happens, the issue would be, first of all, people's health, but secondly, you could see a public loss of confidence in parts of the economy that will be already slow to recover. So it could hurt the recovery, even if you don't have a national level pandemic. Just a series of local ones, of local spikes could have the effect of undermining people's confidence in traveling, in restaurants, and entertainment, anything that involves getting to people together in small groups and feeding them or flying them around. Those things could be hurt. So it would not be a positive development, and I'll just leave it at that.
Thank you. Edward Lawrence.
Thank you, Chairman Powell, for the question. On the industry lending facility, in May we saw at least 55 companies file for bankruptcy. Do you think that it is too late? First of all. Second of all, the future of these facilities, is this a one-year impact to the economy through these facilities, or is this a multiple year? If so, how many years?
We have, significant interest, we think. And also remember, lots and lots of companies are getting financed, too. The banks are lending, the markets are open. You have a much better lending climate than we had in February and March. We don't think it's too late, though. We do expect it to be up quite soon. In terms of the timing of these things, so we'll leave them open for new loans as long as they need to. That'll be a decision we make, of course, with our colleagues at the Treasury Department. And at a certain point, there won't be a need for further loans, and then the assets will be there. And so I don't know if that's part of your question too, but I would just say that at that point, the useful role of the Federal Reserve is probably close to an end at that point. We don't have any expertise in managing pools of credit assets, loans, if you will, or bonds. And we don't want to be we don't really want to be part of the decisions that have to be made to manage such a portfolio. So we'd be looking to have that done either someplace else or by a third party or at the Treasury Department or something. And we're working on ideas for that. But our real focus now is getting these facilities going and getting them to do the job that they need to do.
Thank you. Donnell with Reuters.
Thank you, Chair. So I have two quick questions. One is if we have hit bottom for the economy, and the second question is regarding the way that the pandemic has exacerbated racial inequality. I wanted to ask, to what extent do you think you can factor in those disparities when you're thinking about maximum employment?
I would say that many forecasters had been expecting a bottom for the economy around the middle of the year, with a huge range of uncertainty. I think the labor market, the evidence of one jobs report is that the labor market may have hit bottom in May. We don't know that. We're going to see. And many forecasters widely expect a recovery over the second half of the year. So it is possible, but the thing is, we're not going to overreact to a single data point. We're going to be very careful about reaching any conclusions about good data or bad data. So I think we're going to be here with our tools supporting this economy for as long as it's needed. So, but I think there's a possibility that the bottom has come in the labor market, but we don't know that yet. We'll know more as we go forward. So, in terms of the effect of the pandemic on inequality, what you see, the pandemic, of course, hits everybody, but in an economic sense, it hits those industries that involve groups of people in tight groups, either in places where it's the travel, leisure, restaurant, bars, those kinds of service economy jobs. And so a lot of the lost jobs were from people who work in the service economy dealing with the public, for example, and relatively, compared to other jobs, relatively low wages. So if you just look at what that is, unemployment has gone up more for Hispanics, more for African Americans, and women have borne an extraordinary, a notable share of the burden beyond their percentage in the workforce. So that's really really unfortunate, because if you just go back 2 months, where we had effectively the first tight labor market in a quarter century, and for the last couple of years before the pandemic hit, you were seeing wages go up the most for people at the lower end of the wage spectrum, and that was great. And we were meeting with people from low and moderate income communities all over the country and hearing, don't change this, do whatever you can, keep this going, this is the best labor market we've seen. And we had every expectation, every reason to expect that this would continue, and then this comes. So it's heartbreaking, and we want to get it back. So we really want to get it back, and so I think we learned a number of things over the course of the last few years. One of them is that you can have 3.5% unemployment for a couple of years, and really you see modest moves in wages and relatively almost invisible moves in inflation. So that was not anybody's understanding of the structure of the economy, I think, or most people's anyway. So we can use our tools to support the labor market and support the economy. We can use them until we do fully recover, and that's what we're planning to do. We don't target different groups, but we are cognizant of the fact, though, that late in the last cycle, late in the last expansion, the benefits really do go more to people at the lower end of the wage spectrum for the first time in many years, when labor markets are tight, when unemployment is low. And so we would really like to get back to that place.
Victoria, Politico.
Hi, Victoria Guido with Politico. I just wanted to follow up on a couple of things that have already been asked. First of all, on fiscal policy, you all obviously put out your summary of economic projections today, and I'm curious to what extent future fiscal policy is factored in or not factored in to those projections, and how more or less fiscal policy might affect those projections. And then my other question is on Main Street. You've mentioned multiple times that the Fed and Treasury are willing to expand the program further. So my question is, what's the threshold for those types of changes? Is it just making sure that borrowers that want to borrow through the program are able to do that?
In terms of the way we do forecasts is we don't tend to incorporate things we're highly uncertain about. So I think the forecast would not have included substantial additional big additional fiscal support for the economy, maybe a modest amount, something that looks like a low-end guess on what might come out of the current negotiations. That's basically what would be in the baseline. So, of course, if there were more fiscal support, you'd see better results sooner. But that's a question for Congress. We're spending a lot, and that's really what they get to decide. In terms of Main Street and our willingness to expand it further, I think one thing we're looking at, very strongly looking at, is nonprofits. And is there a way to incorporate them into that facility or a similar facility? So that's another dimension. If we had a great idea for changing Main Street, we would have done it, and we have done some things that I think are really very positive lately here. But as we learn more, it could be in terms of size, it could be in terms of lots of different things. But I think we have a good product to go to market with now, and I think it'll get out there soon, and we'll see, and we'll be willing to continue to adapt.
Thank you, Don Lady.
As you know, the vast majority of people who have been laid off are expecting to be recalled by their employers. At this point, what is your expectation of how much of these job losses will be permanent?
Reliable estimate of that. Clearly, not everyone will go back, but I would say many will go back. But what's going to be the remainder when we reach sort of what is the new normal? It's so uncertain, but it could be a good number of millions of people, I think, in many estimates. But I'd say you're so early in the process. For example, people are going back and looking at other significant changes in the economy, and they've seen how many people go back when, for example, there's technological change and things like that. You may have seen some of this research, and you come up with an estimate. It's just going to be very hard to say. My assumption is that there will be a significant chunk well into the millions. I don't want to give you a number because it's going to be a guess, but well into the millions of people who don't get to go back to their old job, and in fact there may not be a job in that industry for them for some time. There will eventually be, but it could be some years before we get back to those people finding jobs. I mean, when people lose a job, if they can find a job in their own industry, that's usually the fastest way. Is they know other people in that industry, different kinds of jobs. That's usually the fastest. If you have to go to a different industry and start over again, it's much harder, and that's where you start to lose people who are just fall out of the labor force, and it's very tough on their lives. We all know people to whom that happened in the global financial crisis, and hence our desire to do what we can to support this and support this recovery with the tools that we have.
Thank you, Nancy. Marshall Genser.
Marketplace. Chair Powell, I want to go back to the issue of inequality, and I'm wondering what more could the Fed do to reduce economic inequality in this country? I mean, I know that you said you don't target certain groups, but is there a way you could use, for example, the black unemployment rate as some kind of a benchmark to something you want to meet or something that you track of?
We do track all unemployment by all kinds, as you know, all kinds of different demographics, including particularly the African-American unemployment rate, which reached an all-time low since the data started being kept in the modern era. Of course, it's still close to twice the white unemployment. It is twice the unemployment rate, or it was back then. It's certainly much higher now. The best thing we can do with our monetary policy tools is to look at the evidence of what we saw with our own eyes so recently, which is that the economy can have very low unemployment. It could have been lower than we were. It could be lower than 3.5% without seeing financial imbalances, without seeing inflation getting out of control. We frankly didn't even get inflation back up to target, without seeing wages getting out of touch with where they should be. So that's the biggest thing we can do. Inequality is something that's been with us increasingly for more than 4 decades, and it's not really related to monetary policy. It's more related to, there are a lot of theories on what causes it, but it's been something that's more or less been going up consistently for more than 4 decades, and there are a lot of different theories. One of which it just is that globalization and technology call for rising levels of skills and aptitudes in education, and that U.S. educational attainment kind of flattened out, certainly relative to our peers, flattened out over that period. And so that means if you're on the right side of those trends, then those things are good for you. If you're not, then your wages are going to stagnate. And wages for the bottom 10% really haven't gone up in real terms in a very long time, and over a long period of time. Whereas wages for the people at the top, compensation, any way you cut it, before taxes, after transfers, all of those, any way you cut it, compensation has gone up a whole lot for people at the top, and it really hasn't gone up for people at the bottom. If you look more in the middle, then it has gone up for most other groups, but at the bottom, not so much in real terms, in inflation-adjusted terms. So, we call it out as an important factor in the economy, and we will use our tools to support maximum employment and take that definition to heart. But obviously, that's something that's going to require all of society, all of government response.
Thank you. For the last question, we'll go to Michael McKee with Bloomberg TV.
Mr. Chairman, Michael McKee, Bloomberg Television and Radio. I came across a statistic the other day that amazed me. Since your March 23rd emergency announcement, every single stock in the S&P 500 has delivered a positive return. And I'm wondering, given the levels of the market right now, whether you or your colleagues feel there is a possible bubble blowing that could pop and set back the recovery significantly, or that we might see capital misallocation that will leave us worse off when this is over. And second, inequality is not just about wages, it's also about wealth. And a number of studies have suggested that by keeping rates low for so long and targeting the markets after the great financial crisis, that the Fed did contribute to wealth inequality in this country. And I'm wondering if you think there is some tweak or some message you could give that would affect that.
What we've targeted is broader financial conditions. If you go back to the end of February and early March, you had basically the world markets realized at just about the same time, I remember that Monday, that there was going to be a global pandemic, and that this possibility that it would be contained in one province in China for all practical purposes was not going to happen. It was Iran, Italy, Korea, and then it became clear in markets from that point forward. Investors everywhere in the world, for a period of weeks, wanted to sell everything that wasn't cash or a short-term treasury instrument. They didn't want it to have anything, any risk at all. And so what happened is markets stopped working. They stopped working, and companies couldn't borrow. They couldn't roll over their debt. People couldn't borrow. So that's the kind of situation that can be financial turbulence and malfunction. A financial system that's not working can greatly amplify the negative effects of what was clearly going to be a major economic shock. So what our tools were put to work to do was to restore the markets to function. And I think, some of that has really happened, as I mentioned in my opening remarks, and that's a good thing. So we're not looking to achieve a particular level of any asset price. What we want is investors to be pricing in risk like markets are supposed to do. Borrowers are borrowing, lenders are lending. We want the markets to be working. And we're not looking to a particular level. I think our principal focus, though, is on the state of the economy and on the labor market and on inflation. Now, inflation, of course, is low, and we think it's very likely to remain low for some time below our target. So really, it's about getting the labor market back and getting it in shape. That's been our major focus. And I would say, if we were to hold back, because we would never do this, but The idea that just the concept that we would hold back because we think asset prices are too high, others may not think so, but we just decided that that's the case. What would happen to those people? What would happen to the people that we're actually legally supposed to be serving? We're supposed to be pursuing maximum employment and stable prices, and that's what we're pursuing. We're also pursuing financial stability, but there you have a banking system that is so much better capitalized, so much stronger, better aware of its risks, better at managing its risks, more highly liquid. You have all of those things, and they've been lending, they've been taking in deposits, they've been a source of strength in this situation. So I would say that we're tightly focused on our real economy goals, and again, we're not focused on moving asset prices in a particular direction at all. It's just we want markets to be working, and I think partly as a result of what we've done, they are working, and we hope that continues. Thank you very much.
And you've been listening to Fed Chair Jay Powell take questions. Looking candidly, we'll go over some of the headlines in a minute, Carol, but if you look at the S&P just as a gauge, almost to the 10th of the percentage point. Now it's popped up just a little bit. But right as he was taking that last question, an excellent couple of questions by Michael McKee, I might add, the market was almost exactly where it was at 2 p.m. It was like all this whipsawing that we saw go back and forth. Now it is slightly up, just a touch up. But an interesting, series of questions and answers, and sort of what we expected, wide-ranging to the Fed chair.
Yeah, exactly. And I think some of the highlights, no doubt about it, is, he certainly is concerned about what's happened in the labor market, because I thought, he brought up a really good point that because our labor market was so tight, it's when you are in extreme conditions that you start to see benefits go to those at the lower end of the labor market. And Jay Powell's saying we'd like to get back to that and help those lower wage workers again. But I'm just looking at some of my headlines. We're not even thinking about raising rates. I've got to say, I don't have the exact quote, but man, that was just all around Twitter. Bottom line, if you want to know what the Fed is thinking, they're not thinking about raising rates. Yeah. And I just thought it was just fascinating how many times people tweeted, we're not thinking about raising rates. We're not even thinking about raising rates. Yeah. If you had any questions about it, that, he made it very clear. And I thought about the discussion we had going into it, with Francis Donald and Louis Alexander, this whole idea of, his goal was to hold steady, because he knew people were going to come at him with that strong jobs report or better than forecast jobs report. But I thought that was a very, very clear, message in terms of what the Fed was saying, and that they're not going to put their tools away until this is over.
Yeah, and it may be a long time before that is actually the case. All right, let's get a check on headlines and the market from Charlie Pell.
All right, I thank you very much. Here's what's going on. We've got 29 minutes to go ahead of the closing bell. Let's get right to the numbers, give you the why in a moment. S&P up 5 right now. A lot of volatility ever since the Fed chair started talking. We've got the S&P up 0.2% higher by 6 now. Important, though, back in the green at 32.13. NASDAQ keeps on going. Look at that. Another record up 1.3%. Right now up 128 points at 10,081. The year-to-date column. Don't mean to keep dwelling on it, but it is important. So far this year, NASDAQ is now up 12.4%. To put that in context, S&P down 0.5. We've got the Dow up down 81 points right now. The Dow lower by 83 points, down 0.3% at 27,188. S&P 500 did swing between gains and losses as Fed Chair Jay Powell suggested the pandemic could inflict permanent damage on the U.S. economy, even as the Fed signaled it would keep rates near zero, possibly for years to come. Here's what Powell had to say live here on Bloomberg Radio.
At the Federal Reserve, we are strongly committed to using our tools to do whatever we can, and for as long as it takes, to provide some relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy.
In other business news, the retailer Guess plans to close about 100 stores worldwide, roughly 9% of its network, joining retailers across the world that are rethinking the size of their store footprint. Shares of Guess, they are down now by 18.3%. Simon Property Group terminating its $3.6 billion bid to buy Taubman Centers, arguing its rival mall owner has breached the merger agreement by not taking steps to mitigate the fallout from the coronavirus pandemic. Shares of Simon Property Group, right now they are lower by almost 4%. As for Talman, it is plunging by 20%. 10-year yield, 0.74%. Gold up 1.1%, $17.33 the ounce. West Texas Intermediate crude up 1.1%, $39.36 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week on this Fed Wednesday. Carol Massar along with Jason Kelly. Fed seeing zero rates through 2022, committing to keep buying bonds. Some of those headlines from the Fed chief. Let's get to Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence. He's on the phone in New Jersey. Lindsay Piegza back with us, Chief Economist at Stifel Financial. She joins us on the phone from Chicago. And, Ira, I want to start with you. It feels like the market's kind of ending up where they started before the Fed decision. But what's key for you as you heard from the Fed chief?
Not at all, Carol. I mean, the yield curve has flattened quite a bit. If you look at 2s, 10s or 5-year versus 10-year treasuries, I think that the two things really caused the treasury market to react pretty, at least noticeably, if not significantly. One is that the dot plot being as dovish as it was, with the median forecast of Fed members saying that they're not going to hike rates until at least 2023, that has meant that you had a pretty significant rally in 5- and 7-year rates, actually, and then on the other side, the chairman mentioning yield curve control in his opening remarks, and then also in response to a couple of questions, I think also contributed to additional buying of treasuries. So I think the support that the market had back in March that's been ebbing. I think the Fed leaves open the possibility that you'll have even more asset buying in the future if the recovery doesn't accelerate from the way that some of the members of the Fed hope.
So, Lindsay Piegza, as I look at what our colleagues on the Bloomberg Top Live blog were saying, as I look at the equity market reaction a little bit, I mean, it seems like everybody was kind of trying to make up their mind of what they were hearing, both tonally and I think in substance from the Fed chair. What was the most important thing you heard him say?
Well, I think the most important thing was the tone of reassurance. The Fed chairman really reiterating the notion that the committee will continue to do whatever it takes to support the economy. Now, on the one hand, they pointed out that the policies already implemented have been relatively favorable. They point to improving financial conditions specifically. Again, longer number of tools still in our toolbox. We have not exhausted those yet, and we will.
You know what? We're having some problems with Lindsay's line, so we're going to try and get a cleaner line. So let's go back to Ira Jersey. And Ira, I should have clarified, the equity markets seem to kind of, bounce around and then settle back to where they were. But you're right in terms of the Treasury market, in terms of what we got. So, what's the next focal point, do you think, that's going to be really key for market watchers, especially when it comes to the fixed income market and really some of those economic data points? As Jay Powell, several times reminded us, this was one data point, that jobs report we got on Friday. And you could tell he's worried about the labor market.
Yeah, for sure. I certainly read his comments that way as well, that, he and everyone else, quite frankly, were surprised by the data. And obviously the data is going to be very noisy, I think, over the next couple of months. So I think for the rate market, it's going to be this push and pull. So the idea is, how serious are they at implementing something like an open-ended quantitative easing that would be yield curve control and defending a particular rate versus the amount of Treasury supply that's coming to the market. So obviously to fund all of the fiscal stimulus plans, and certainly if there's another potentially $1 trillion fiscal stimulus in the future coming down the pipeline, then that's just going to add to the amount of treasuries that are going to have to be issued. And you've already seen a little bit of friction as some of those bonds have been issued over the last couple of weeks. T-bills in particular, but also even 10-year notes yesterday had their weakest treasury auction that we've seen in quite a few months. So I think that's the push and pull that's going to go on. And obviously the traditional economic data is going to matter, but I think you have to look through the next couple of months, and we won't really get a clear picture until August or September as we start to get a little bit deeper into the data cycle.
Yeah, so talk a little bit more about that if you can, Ira. Deeper into that data cycle, what exactly are we looking for? Who are we looking toward to really get that good sense? Because you're right, it's been very hard to kind of get a handle on what's important. And even the Fed chair basically being like, listen, let's not get way too excited about last Friday's number.
Well, I think in a way the data is going to be lagging some of the real-time data that we can look at. So I think it's things like where are aggregate cases and deaths from coronavirus, for example, and then what is the policy response for that, right? So do you see more and more states opening up because the number of cases being reported per day has gone down? I mean, I live in New Jersey, as you noted at the top of the show, and we're starting to reopen. We had one of the most draconian sets of social distancing, and now we're starting to slowly open up. And when you look at cases per day are now at 300 instead of at 3,000. As you get that data, I think that data might actually push markets and be more important, certainly to risk assets. I think than so things like corporate bonds and equities more than ISM data, for example.
I agree with you. I think a lot of the CEOs and individuals we've had, they said, it's a healthcare story. It's a healthcare problem. Just quickly, I just wanted to ask you, he said many officials see different possible paths for the economy. Just got about 30 seconds. So what? Healthy debate going inside the Fed right now?
Yeah, well, I think that just shows the uncertainty, both at the Fed but also in the markets in general. Like we don't know what the path of the recovery is. But in my view, it's more of a duck-billed, fat tail, reduction, because we know now that the pace is probably going to be positive from here. The question is, what is how fast and or how flat is that recovery going to be?
All right. Well, we really appreciate it. We know it's a busy day. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Joining us on the phone from New Jersey, Lindsay Piegza, Chief Economist for Stifel Financial, on the phone from Chicago. This is Bloomberg. And let's head over to Nancy Lyons. She is down in D.C. She's got world and national headlines. Hey, Nancy.
Hey, Jason. George Floyd's brother, Philonise, is urging lawmakers to bring about meaningful change in policing following his brother's death. He told the House Judiciary Committee today his brother's death was unfair and unjust.
George called for help, and he was ignored. Please listen to the call I'm making to you now, to the calls of our family and the calls ringing out the streets across the world. People of all backgrounds, genders, and races have come together to demand change. Honor them. Honor George.
He says his brother did not deserve to die over $20, a reference to a counterfeit bill his brother allegedly used at a convenience store. The House has developed a package of reforms, including a ban on chokeholds and a national registry for police violations. The Senate is also working on a proposal. NASCAR is taking a look at racial diversity. The sport's lone black driver, Bubba Wallace, is calling on the sport to ban the Confederate flag. He says there's just no place for it. The Republican National Committee could be close to a change of venue for its convention this summer. Bloomberg's Nathan Hager with more.
The GOP is likely to move at least part of its convention next month to Jacksonville, Florida. That's after it failed to reach an agreement with the original host, Charlotte, North Carolina, on the scope of coronavirus safety measures. Sources tell Bloomberg the convention's lower-profile meetings could still be held in Charlotte, but the marquee event, President Trump's acceptance speech, will be held in a place where officials have said they're willing to host a large indoor gathering. Nathan Hager, Bloomberg Radio.
Global news, 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Why do hedge funds and other alternative managers rely on Pershing for a highly personalized experience? Mark Alderati, a managing director at BNY Mellon's Pershing and head of Prime Services, explains.
In today's fast-paced environment, where the only constants are change and volatility, you need a prime broker who's both steady and agile, focused on supporting your needs so that you can focus on growing your business and producing results. Exceptional client service and advocating for our clients is at the core of what we do. Our award-winning high-touch team is just one of the benefits of working with BNY Mellon. We help alternative investment managers create great experiences for their clients. Whether it's customized financing, securities lending solutions, platform access, or outsourced trading, BNY Mellon's Pershing is a prime broker who's committed to this business and dedicated to meeting your evolving demands.
To learn more about the unique and industry-leading solutions for hedge funds and other alternative managers, visit Pershing.com. Pershing LLC. Member FINRA, NYSE SIPC.
Have you wanted to speak a new language, but you thought it'd be too hard or take too much time? Then go to Babbel.com, download the app, and try it for free. In just 15 minutes a day, you'll be on your way to speaking a new language in just a few weeks. And right now, you can try Babbel for free. Babbel starts out teaching you words and phrases by matching them with pictures. You won't believe how easy the interactive program is. Soon the sentences get a little bigger, and before you know it, you're having simulated conversations voiced by native speakers. And because Babbel is crafted by language experts and uses the spaced repetition method, in just 10 to 15 minutes a day, you'll be speaking the language of your choice with real confidence. With Babbel, you can speak a language. Just go to Babbel.com and start your first lesson in the language of your choice for free. Download the Babbel app or go to Babbel.com and try it for free. That's Babbel.com.
This is a message from the government about the next stage of controlling coronavirus with NHS Test and Trace. To protect your friends and family, testing and tracing must become a new way of life. If you have symptoms, you need to get a test immediately. Don't leave home for any other reason. If you test positive, we will contact you to trace people who you might have infected. From now on, if you're told you've been exposed to an infected person, you must self-isolate for 14 days. Play your part and do the right thing so we can safely return to a more normal life. Go to nhs.uk or call 119. Stay alert, control the virus, save lives.
To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. Avoid close contact with people who are sick. Remember, 6 feet, it's the rule. Stay your distance and always wear a mask while you're out. Avoid close contact with people who are sick. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
Wanna bet football can make you feel nostalgic?
Playing days are over, so...
On the podcast, NFL Alumni Lounge, Charlie Booth sits down with retired NFL legends to talk about their careers, life after football, and everything in between.
This is Darren Waller. Good to have you.
Yes, sir. It's good to be here.
Dana White, welcome to the Alumni Lounge.
Thanks for having me, brother.
Big member of our NFL alumni family, the CEO of the XFL, Mr. Oliver Luck.
Charlie, good to see you. Thanks for having
me. We're here with the president, Mr. Eric Price. Good to see you.
Search NFL Alumni Lounge on TuneIn to listen.
Are you fully informed on the NBA? On the NBA Hangtime podcast, veteran sports writers Sekou Smith and John Schumann analyze the latest NBA news, storylines, and discussions with guests from around the basketball universe.
Isaiah Thomas joined us here on the Hangtime podcast. Isaiah, good morning.
Everybody's doing well. As you know, my daughter tested positive.
Search NBA Hangtime on TuneIn to listen.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
With the NHL season temporarily on ice, now is a good time to catch up on past games.
Bergeron, he scores!
With game replay on TuneIn, you can listen to every power play, slap shot, and goal of the 2019-2020 season so far.
Suter to Cunnin to Fiala, he scores!
And for a limited time, it's free for hockey fans everywhere. Search classic game replays to start listening.
Buckle up, race fans.
NASCAR is back in the driver's seat.
And you can cut straight to the action here.
With the Performance Racing Network on TuneIn, you can hear PRN's live coverage of some of this year's top events.
As NASCAR's top drivers, Kevin Harvick,
Clint Boyer, and more get back on the track.
Search Performance Racing Network to listen and see upcoming races. Want to relive the glory of college football?
Pulls over a man into the end zone.
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship featuring Clemson and LSU.
There are going to be 2 champions on the field tomorrow night. There's going to be 1 team hold up the trophy.
10, to the 5, touchdown!
Search classic game replays to listen for free.
Breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. Fed Wednesday, it has been a tumultuous trading session with the S&P now lower by 12 points at 3195, down 0.4%. The Dow down 235 points. That is a drop of just about 0.9%, while NASDAQ continues its advance, trading at a record at 10,033, up 79 points for NASDAQ. That is a gain of 0.8%. Stocks fluctuating. The dollar slumps as investors assess the Federal Reserve's views on the economy. Right now, the 10-year yield 0.73%, up 27.30 seconds right now. Gold is up 1.3% higher by $22 the ounce at $17.38. And West Texas Intermediate crude now up 0.6%, $39.16 a barrel. Bottom line, volatility with the S&P down 9, drop there of 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, it is time for the drive to the close. Let's check in with our man Sean Cruz, manager of trader strategy at TD Ameritrade, joining us on the phone from Chicago. And, you know, Sean, we were watching the tape as it went through Jay Powell's press conference. It's been a funky one for a long time now, but it was interesting to just watch almost tick by tick. You could see people being like, I mean, I'm using very technical market sounds there. But interesting to watch how dependent this market really is on Jay Powell and friends.
Yeah, and I think what the markets were trying to get was some guidance, one, on where interest rates were going to be, not just for the time being, but looking forward for the next year or two.
Yeah.
And then also looking at what they were going to do with asset purchases. So I think on one hand, they got what they wanted. That is, we are going to get the rates remaining in the 0 to 25 basis points range, and we also got what we wanted from asset purchases. But I think that they plan on keeping those rates lower, I think a little bit longer than the market anticipated. Sort of doesn't put you in a good place mentally about the trajectory of the economy. If you are going to need rates that low for that long going out through 2022, what does that say about your expectations for what the economy is going to be doing? And I think trying to reconcile that was what caused a lot of that volatility back was going on.
Well, Sean, right? It's like, wait a minute. Okay, that's cheap money for a really long time. Wait a minute. That also means the economy's not so great, right? Like it's that yin-yang that was going on.
Wait a minute.
I think so. And so it's hard to imagine it where, one, you're going to start getting some recovery in employment. You're going to get some recovery in economic activity, but you're not going to get any sort of inflationary pressures to go along with it or anything else that would necessitate the Fed having to push rates higher, at least before 2022. So that's one thing where the market sort of read through into that. And then if you're looking at rates being that low that long, it's not going to help out some of these sectors that need higher interest rates or take higher interest rates sort of as a good sign of economic activity, and that's financials, that's industrials, and you definitely are seeing those sectors remain under pressure post-conference.
Right.
So, Sean, I have to ask you, amid all of this, and today was no exception, we continue to see tech stocks, I was going to say grind higher, but there's not really a grind. It's just like they're going up.
No friction, it feels like.
Yeah, not a lot of friction there. I do wonder what you make of, especially the big tech names, the FANG names, amid all of this, because they continue to really hold everything up. I mean, the NASDAQ is up 10% on the year at this point, plus.
So it's almost like you have to think of this not in terms of cyclical versus defensive. You almost have to think of it as stay-at-home versus reopening. And when you get the stay-at-home theme prevailing, that maybe we're not going to reopen as fast as we were hoping or expecting, that's when you start to see some of these tech names, and I think it's been well documented, just the impact that Microsoft, Amazon, Apple, Facebook, Google have on the NASDAQ. Whereas if you're looking at the S&P 500, where there's a lot more, like we just talked about, industrials, financials, energies that make up a decent amount of that index as well, it makes sense that you can see the NASDAQ really take off, especially when the stay-at-home theme prevails, because you've got 4 or 5 names that make up so much of that index, but also can benefit from the stay-at-home economy. And even if we start to reopen, they're probably going to be in a good spot to reopen moving forward as well.
Well, don't you wonder, I mean, Sean, I don't know, you've watched the markets for a while. Do we at some point wake up and say, this is our economy, this handful of tech names largely, and anybody connected with them is our economy going forward? Or are we being kind of stupid in thinking that?
I don't think it would be wrong to think that companies like Amazon and Microsoft are just bringing so many users and so much activity onto their platforms, and a lot of that probably will remain sticky moving forward. I think you've already seen some of that play out, and if you look at just the market capitalization, how much that has shrunk in some of those other sectors. You can even look at some of the consumer discretionaries. If you take Amazon out of the consumer discretionaries, there's been a significant drop in the market cap of discretionaries, market cap of industrials and energy companies. So the index is already sort of starting to reflect that is really going to be more representative of economic activity moving forward, will be in those big technology and communication services companies.
Can I ask you about one thing that's a little maybe sort of offbeat, which is, you look at some of these bankrupt companies like Hertz and JCPenney's, and, these are well-known names to folks, and yet you've seen these little runs in them. These are companies that are, if not going out of business, being dramatically restructured legally. Help me understand that.
Well, that was a little bit of a head scratcher to me as well, because that's sort of just a given in any sort of bankruptcy or debt reorganization. If you are an equity holder, the first and easiest item to check off the list is equity goes to zero.
Yeah.
So I think that was a little bit of a mystery, and so that almost makes me wonder if there was going to be some sort of a deal or something put on the table where they were going to find a way to maybe take the company private or recapitalize the company without having to do that. But that was a very short-lived, what I think is maybe just a little blip in the pricing that reversed itself fairly quickly.
Interesting.
Well, and it is an interesting time. I just feel like there's so many people weighing in, like, we had John Paul Tudor Jones, eating some humble pie, all of these big investors who were, saying back in March or even sooner, like, this is not a market to be in. And then yet here we are. So I don't know. What are your expectations? What kind of visibility do you have in terms of the equity trade right now?
Well, what we noticed, and I can speak for TD Ameritrade clients, and that is we actually saw our clients start lowering exposure to equities at the start of the year. And we actually hit a 7-year low in March for equity exposure in clients. And it sort of turned around from there. So I think clients started dialing back exposure once we hit those lows in March. And it was sort of one thing where we've had about a decade to see how this plays out, but the Fed came in March, and they really announced some pretty extraordinary programs. We also got financial support packages that were pretty extraordinary as well, and I think investors saw that as an opportunity maybe to get back in. And that was really meant to address what I think was the big concern and issue for the market, and that was leverage and solvency issues. And everything the Fed and Congress did seem to be pointed to address those solvency issues or default.
Sounds like a little bit of market timing to me, and those were good. Those were like good calls.
Smart
they
clients.
did that.
Smart
Right?
clients. All right, Sean Cruz, thank you so much. Manager of Trader Strategy for TD Ameritrade, joining us on the phone from Chicago. Coming up, we're going to get you to the close of trading on a little bit of a funky day. We were waiting for the Fed. They spoke, and the market went, all right.
With a new day comes new COVID-19 information.
Interesting commentary from the president.
Don't miss a detail.
They're in the process of working with area hospitals.
Bloomberg Daybreak, weekday mornings at 5 Eastern on Bloomberg Radio.
This is a Bloomberg Pursuits look at luxury. Las Vegas casinos have reopened with $30 a night rooms on the Strip. And in a typical Vegas way, that meant go-go dancers in masks, even if patrons weren't much wearing them. The Nevada Gaming Control Board said resorts should operate at no more than 50% capacity on their gambling floors. Some casinos opened with sneeze guards around their card tables, and hand-washing stations have been interspersed among slot machines. It should be no surprise that a company whose sales are generated by literal sparkle inside a luxurious store would have no sparkle in sales during a pandemic with stores closed. Tiffany has posted a loss for last quarter with sales far below forecasts. If you'd like an international vacation with no quarantine, that'll cost you $115. Iceland is giving arriving passengers a choice between a 2-week mandatory quarantine or paying for an on-the-spot COVID-19 test. Tourism accounts for almost half of Iceland's export revenue. Visit BloombergPursuits.com for more. I'm Andrew O'Day, Bloomberg Radio.
Asset managers who seize change to launch new strategies, add distribution channels, or exploit new technology to re-engineer the investor experience are often rewarded. However, in an industry paralyzed with complexity, few act with agility or decisively. Few run their business strategically. Yet, the most competitive managers in the market know, with the right partner and a flexible operating platform, you can. Go boldly toward change with SEI Investment Manager Services.
Determination and operational strength are both essential factors for growth in asset management. I'm Steve Meyer, President and Head of SEI's Investment Manager Services Division. We know that disruptive forces create opportunities around the world. If you see potential in change, our industry specialists will maximize SEI's integrated platform of data and risk management, global investment operations, compliance support, and investor services to position your asset management business for success. Come grow with us.
With SEI Investment Manager Services, you lead the charge in a competitive marketplace. Learn more at SEIC.com/seize change.
Business and finance have always held surprises, but this is brand new.
The move risks fueling more demonstrations, and Stokes' concerned that essential freedoms will be curbed.
Karen Muskow and Nathan Hager.
Chinese lawmakers approved national security legislation.
Expert navigation through uncharted territory.
Tell us the range of outcomes that we could see on that front.
Bloomberg Daybreak, weekday mornings at 5 Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening. From the financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellico. Wednesday, Fed sell-off. The Dow, the S&P lower. NASDAQ keeps on going. Another record there, up 64 points on NASDAQ to 10,018, up 0.6%. S&P down 17, down 0.5. The Dow tumbled 282 points. That was a drop of just about 1%. This update brought to you by Witham, a forward-thinking advisory and accounting firm helping clients to be in a position of strength in the new reality of business. Learn about their innovative solutions by visiting Witham.com. Stocks fluctuated right into the close. The dollar slumped as investors assess the Federal Reserve's views on the economy. Treasuries rallied. The S&P 500 index swung between gains and losses as Fed Chair Jay Powell suggested the pandemic could inflict permanent damage on the American economy, even as the Federal Reserve signaled it would keep rates near zero, possibly for years to come. Sean Cruz is manager of trader strategy at TD Ameritrade. He was our guest moments ago, right here on Bloomberg Business Week.
they plan on keeping those rates lower, I think, a little bit longer than the market anticipated. Sort of doesn't put you in a good place mentally about the trajectory of the economy if you are going to need rates that low for that long going out through 2022. What does that say about your expectations for what the economy is going to be doing? And I think trying to reconcile that was what caused a lot of that volatility back and forth.
The 10-year up 28.30 with a yield of 0.73%. Gold up 1.4%, 17.38 the ounce. Crude up 0.2%, 39.02 a barrel. Tesla shares surged 9% today, closing above $1,000 for the first time. Year to date, Tesla is up by 145%. Starbucks expects the coronavirus pandemic to reduce sales this quarter by as much as $3.2 billion. Starbucks shares down 4.1%. Recapping, S&P down 17. I'm Charlie Pellett. That's a Bloomberg Business Flash.
Wild thing, think you move me.
I got a few moves I know you'll like.
Oh, come on, Tina. Shake him, not stir.
Just move on toward your destination.
I can make things move without touching them.
Shaking all over.
Bloomberg Business Week, Movers and Shakers, with Carol Masser and Jason Kelly on Bloomberg Radio.
I just have to go back to what Charlie just said about Tesla. And I heard it earlier in the day when Tesla shot above $1,000 for the first time ever. The close, $1,025.05, so $1,025.05. Stock is up 145% so far this year. And I just think about, long and winding road for Elon Musk, but man, here he is. And I know they've
talked about... But not very winding this year. I mean, it's more or less up.
But
it's
think
amazing.
about the last couple of years,
no,
right?
I know.
And
Listen,
Elon
420.
tweeting and questions. Right, exactly.
420 means $420. And now, as you say, we're talking about above $1,000 a share.
Right. And they talked about increasing demand, ramping it up for their Model 3 in China. They had a Wedbush analyst come out and tout the massive market opportunity, its ongoing battery efforts. And I like a creative genius. I'm going to put it out full transparency, but man, that is just remarkable.
Well, if you look at the chart, the GPW chart, the GP space W chart, which takes you all the way back to 2015.
Yeah.
It was like sort of rocking along, and then just like in late 2019 went way up, and then in mid 2019 just cratered. I mean, cratered if you look at it. And then just incredible.
Right? Apparently, Elon Musk put an email out to employees before today's market open declaring that it is, quote, time to go all out and put Tesla's Semi into volume production. And we're talking about their zero-emission semi-truck. It's just remarkable.
It is. You want to talk about the S&P?
Sure.
Big picture? You love to do the big picture?
Yeah, I do love to do it. So let's do it because we did bounce around and we finished off our highs and lows on those major equity averages.
And negative. I mean, really, when you look at the breakdown, right?
Yeah. Overwhelmingly, 397 names in the S&P 500 losing some ground today, 107 higher, one unchanged. And if I look at, let me just pull up major industry groups, only group among the 11 major industry groups in the S&P that gained ground, information technology, which was up about 1.8%. Bottom of the pack were the energy names, which were down about 5%, but overwhelmingly a bearish tone here.
I just want to talk about one name familiar to our audience for a number of reasons, one of which is we talk about retail a lot, and we've had the CEO of this company on our show the year ahead, talking about Simon Property Group basically coming out. They had done a deal with Taubman to sort of get together and put these two retail companies together, commercial real estate companies together, and Simon Property Group coming out and being like, you know what, this pandemic, not so into it. We're not going to do this deal. And it was bad news, I think, for SPG, that's Simon Property Group investors, because I think they really felt like there's probably strength in numbers here and strength in scale, and they bid that stock down today, Simon Property Group that is, and ended up down 4%, closing at 83.01.
Yeah. Boeing down about 6.5% today.
Yeah, I was actually a little bit surprised at that because I think they came out and were more specific about when they are going to get that 737 MAX recertified. So I want to take a look at the headlines here. Key flight there targeted for June. But, people still aren't really, shall we say, excited about Boeing. It just hasn't. It's been a bit of a tough story. I'm looking at what it's done for the year.
Well, there was also,
almost 40%.
There was a $44 billion tanker decision, and the Air Force is delaying by 4 years a decision on whether that $44 billion tanker program should be approved for full rate production while Boeing tries to show it has fixed the flaw camera or the flaw camera system. So I think there's some conflict. You know what I mean?
Yeah, I mean, we did hear, it's interesting, I was thinking back, our conversation yesterday, driving to the close with David Dietz. He likes Boeing and basically said Airbus, their chief rival, really the only other big plane maker, is having some problems, and there are only a couple places you can go.
Right, you want to buy a big plane? You've got Airbus and Boeing right now. As much as China would like to have an offering.
Until you start Masser Aviation, and start building planes.
You wonder what I've been doing at home. Am I working from home? It's not just this show.
You've been building planes in Jersey City.
I got a little bit of a backyard.
Yeah, just like put together a plane. Yeah.
Using everybody's yards.
Jumbo jets there.
Should we talk about Gap was down a lot too, right?
Gap was down. I mean, it's interesting. Gap was down. Norwegian Cruise Lines was down. UAL was down.
Gap was down almost 12%, 11.5%.
I just wonder, some of these names have been incredibly volatile just as we collectively say, hey, we're reopening, like we're going to be shopping, we're going to be dining, we're going to be traveling. And then there's something that comes out like Anthony Fauci, our old friend, being like, womp, womp, nope, this is far from over. And then people go,
don't get your shopping bags ready, folks.
Yeah. Actually, maybe I'm not going to go on that trip, or maybe I'm not going to head out and buy some clothes to go back to work. I mean, it can be that simple.
Places you shop at, Guess and Chico's, they came out and they reported quarterly results, and so I guess there was some disappointment. There's nothing wrong if you do.
I liked how effortlessly you did that. Guess and Chico's. Yeah, I'm definitely a Guess and Chico's kind of guy.
You could be. There's nothing wrong. Guess and Chico's.
I don't think they sell a lot of men's clothes, though. I mean, I like a nice culotte, but
There's nothing wrong with culottes. Might have one or two in my but anyway, I think anytime
you can pull off a culotte much better than I can.
I don't know how to take that, but I do think when you see any disappointing, what's interesting is the Gap price target was raised to $110 a share from $9 or from $11. Wait, to $11 a share from $9 by Morgan Stanley. So you actually an upgrade. And yet,
did you just say it was raised to $110 from $9?
But I corrected myself.
Okay, good.
To $11 from $9.
Yeah, because I think if someone had raised, then you would have expected the shares to go up.
But even with that price target raise,
people were like, nah, I'm not buying it.
Yeah, exactly. And not buying apparently things. Yeah, exactly.
Yeah.
Should we do the VIX?
You show me a new line of fall culottes, and then I'm in on GPS.
All right, I am moving on, folks, from Guess and Chico's. Volatility index report just up a hair, up 0.25%. The VIX closing, Jason, at 27.68.
All right, let's get some world and national headlines now. For that, we go to Mark Mills. Hey, Mark.
Hey, Jason and Carol. One day after George Floyd was buried, his brother Philonis testified before a House Judiciary Committee hearing on police practices and law enforcement accountability. Floyd was questioned by committee chairman Jerry Nadler.
Can you think of any reason why Officer Chauvin would need to hold his knee on your brother's neck for over 8 minutes?
No, sir. I don't really know why he did it, but personally, I think it was personal.
More than 1,250 former Justice Department workers on Wednesday called on the agency's internal watchdog to investigate Attorney General William Barr's involvement in law enforcement's move last week to push a crowd of largely peaceful demonstrators back from Lafayette Square using horses, flashbang devices, and pepper spray. The Justice Department did not immediately comment. The nation's overall count of new coronavirus cases rose earlier this week by just under 1%, the smallest increase since March. However, a month into its reopening, reopening. Florida reported more than 8,500 new cases this week, the most in any 7-day period. In Texas, hospitalizations on Tuesday jumped 6.3% to 2,056, the highest since the pandemic emerged. And California's hospitalizations are at their highest since May 13th. Dr. Anthony Fauci, the nation's top infectious disease expert, said reopening is not a sign to avoid COVID cautions.
You still should be wearing a mask. You still should be trying as best as possible to have that physical distancing. You still need to wash your hands as often as you possibly can and avoid congregation in large numbers.
Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Mark Mills.
People love a good story. They like it even better when that story is real.
Is this something strange in the numbers?
Paul Sweeney.
That seems like a big miss to me.
Bonnie Quinn.
New funds getting started in order to take advantage of what might be a moment.
Bloomberg Markets, weekday mornings at 10 Eastern.
If Russia does throw this spanner in the works, what does it do to relations going forward?
On Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com.
How important is that statement there?
Bloomberg, the world is listening.
Sweet strawberry icing. You're in Goodwill, and just past that vintage denim jacket you spot miniature donut earrings. You lean in. Ah, that's the scent of shopping success. Because at Goodwill, every item you buy funds local job training and more. So bring home those donut earrings and bring home so much good to your community. Goodwill. Bring good home. Brought to you by Goodwill and the Ad Council.
It's a stock market driver.
Now they're starting to see a little bit of panic from policymakers.
It's a global political force.
How will this epidemic reshape big tech and its relationship with Washington?
It's a virus.
This coronavirus is a global pandemic.
Is there a safe haven?
And the facts matter.
The situation is so bad because of the virus that is simply unavoidable.
Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
There are everyday actions to help prevent the spread of respiratory diseases. Wash your hands. Avoid close contact with people who are sick. Avoid touching your eyes, nose, and mouth. Stay home when you are sick. Cover your cough or sneeze. Clean and disinfect frequently touched objects with household cleaning spray. For more information, visit cdc.gov/COVID-19. This message brought to you by the National Association of Broadcasters and this station.
Are you in? You know that feeling when you get more than you expected? Like when your week off is forecast warm and sunny. Or when there's an extra unclaimed sausage left on the barbecue. Or joining Tesco Mobile and finding out you get the latest phones and 99% UK network coverage. Yeah, that feeling. Nice, isn't it? Tesco Mobile. Every little helps.
99% 4G population coverage indoors and outdoors across UK.
This is a message from the government about the next stage of controlling coronavirus with NHS Test and Trace. To protect your friends and family, testing and tracing must become a new way of life. If you have symptoms, you need to get a test immediately. Don't leave home for any other reason. If you test positive, we will contact you to trace people who you might have infected. From now on, if you're told you've been exposed to an infected person, you must self-isolate for 14 days. Play your part and do the right thing so we can safely return to a more normal life. Go to nhs.uk or call 119. Stay alert, control the virus, save lives.
Where will 2020 take you? Somewhere where people care about each other, about our planet, about creating a better world for everyone, and becoming the best versions of yourselves. Join a community of like-minded individuals at the University of Winchester. Make sure to accept your offer by the UCAS deadline and visit our website to find out more. See the bigger picture. Be the difference. Go to winchester.ac.uk.
There's a reason flash storage is called flash storage and not electronic non-volatile computer memory storage. From quick and efficient data retrieval to instant scalability, everything about IBM flash storage is fast. It's also cloud-ready and surprisingly affordable, with a recommended monthly price of £310 for 24 terabytes of all flash. Order by the 30th of June and pay nothing for 90 days. Find out more at ibm.biz/flash offer.
Want to relive the glory of college football?
Balls over a man, into the end zone.
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship, featuring Clemson and LSU.
There are going to be 2 champions on the field tomorrow night. There's going to be one team hold up the trophy.
10, race to the 5, touchdown!
Search classic game replays to listen for free.
Are you fully informed on the NBA? On the NBA Hangtime podcast, veteran sports writers Sekou Smith and John Schumann analyze the latest NBA news, storylines, and discussions with guests from around the basketball universe.
Isaiah Thomas joined us here on the Hangtime podcast. Isaiah, good morning.
Everybody's doing well. As you know, my daughter tested positive.
Search NBA Hangtime on TuneIn to listen.
Ready for a one-of-a-kind look at the NFL? On the PFF NFL podcast, Steve Palazzolo and Sam Munson interpret the unique stats of Pro Football Focus to analyze the league, uncover secret superstars, and discuss which teams to watch out for in the next Super Bowl.
Let's talk some football. Let's do it, Steve. All sorts of stuff. We're going to do most improved defenses around the NFL. Solomon Wilcots, our very own. He went into some detail over at PFF.com. Most improved defenses around the
Search PFF NFL on TuneIn to listen.
How do you keep track of all your favorite stations and podcasts? Easy. You add them to your favorites list. Just find the audio you want to bookmark and tap the heart icon. Then, whenever you want to browse your favorites, you'll find everything under the Favorites tab.
News 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pelota. Move lower for the S&P and the Dow. Another advance for NASDAQ. Another record there. Stocks and the dollar fell as investors assess the Federal Reserve's views on the economy. Treasuries rallied. S&P ended lower after getting whipsawed as Fed Chair Jay Powell suggested the pandemic could inflict permanent damage on the economy, even as the Fed signaled it would keep rates near zero, possibly for years to come. S&P 500 index down 17, a drop of 0.5%. The Dow down 282 points, lower by 1%. NASDAQ up 66, that was a gain of 0.7%. 10-year up 27.30 seconds with a yield of 0.73%. Gold advanced 1.3%, 17.36 the ounce. And West Texas Intermediate crude up by 0.1%, 38.97 a barrel. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to Bloomberg Business Week. Well, this has been a story that we have followed very closely, and it's one of those stories, Carol, where I thought, I wish someone really smart would write a story about this and tell us what it means in the broader context. Someone who really understands Silicon Valley, and leave it to Business Week to find that exact person within the empire. We're, of course, talking about Kurt Wagner, tech reporter for Bloomberg. Joining us on the phone from Denver. Also joining us, Joel Weber, the editor of Bloomberg Business Week. Joining us from Brooklyn. All right, Joel, as usual, you guys are all over it. Tee this up for us.
Well, you laid it out perfectly. The moment that Twitter sort of put a fact check label on a Trump tweet, we were like, can we get a pitch from somebody about what's going on there? And then Kurt just filed basically an immaculate draft that we were like, yeah, you could just go ahead and publish that now.
Cut and paste, put in the magazine, send to print.
Yeah, exactly. But it also just became an excuse for just a great piece of art that our art department came up that has President Trump sort of inside a gilded birdcage. But I think the real importance of this story is going to be something that we're going to all kind of see in the weeks and months ahead, and it really comes down to we have a very prominent user of a platform in President Trump and his use of Twitter, and here we are heading into re-election season, and we're going to really watch closely, all of us, as to how this sort of little rivalry unfolds. But Kurt, in your reporting, what did you sort of uncover about the dynamics at play here?
Well, we had been thinking about this for months now. I think I had a story in January that kind of went deep, specifically on this interstitial that Twitter is using to label tweets from politicians. just because we knew that at some point the company would be forced to use this, on a tweet from President Trump. And so I think what we knew then and what we certainly know now is just how complicated both the company's policies have been, but also the discussions internally about when to enforce those policies against someone who is the president of the United States. I mean, it is like not a coincidence that it's taken them 3.5 years to finally take action on his tweet. I've heard part of it is that they didn't have policies in place beforehand, but I think a real part of it is that they just weren't comfortable that they could actually do that. And clearly now they've opened the floodgates. I think we've seen them label 3 of his tweets in the past 2 weeks. And so with 5 months to go before the election, this will not be the last we hear of this, I'm sure.
I got to say, though, Kurt, as you so, rightfully include in your story, there's been lots of times where they could have Twitter come out and kind of flag a tweet from the president in the past, and yet they didn't. So I do wonder what you uncovered about some of the internal conversations that ultimately got them to this point.
Well, one of the things that a lot of people talked about was that they didn't have the policies in place before this. And it's a little bit of a cop-out because that's not true, right? They did have policies against things like racism or promoting violence. And he oftentimes walked right up to that line, and a lot of people would say cross that line. But what they mean when they say that is that Twitter also had this policy around newsworthiness. So what they would say is, okay, yes, maybe President Trump did cross the line, but his account is so newsworthy, we can't actually take it down. And before about a year ago, there was nothing else they would do. They would just simply leave it up, and there would be no explanation or anything like that. About a year ago was when they first launched what they call an interstitial, which is basically this warning label that appears in front of the tweet to say, hey, this is a violation, but we're leaving it up because it comes from the president. And so, by that standard, they would say this is really the first time he's violated the rule since they launched that a year ago. That's probably debatable for some people. But again, that almost excuses everything he had tweeted up until about June of 2019.
And Kurt, how much more policing might we see from Twitter on this front? I mean, do they have a person who's just sitting there at all hours of the day monitoring the president's account?
Yeah, probably all 50 tweets per day that we see from the account, I think, are probably closely scrutinized internally. But what they have said, especially on the misinformation stuff, which is what they first kind of flagged, if you'll recall those tweets from him about mail-in ballots, that was really where this all started. And what Twitter has done is really left the door open. They've said, we're only going to police misinformation in a few very specific categories. COVID-19 related misinfo is one, election and voting misinfo is another. That's where the president kind of crossed the line in their eyes. But they've said we can expand this into any category we want, basically whenever we want. So as of right now, if you were to tweet something that's inaccurate around healthcare, for example, or immigration, there's no policy in place that Twitter would actually, fact check that tweet. But they've said they can expand it whenever. So they've really kind of set themselves up for a lot of leeway here. I don't know if they really have the resources to go fact check everything that everyone posts on Twitter. In fact, I know they don't have those resources. But they've certainly given themselves a lot of power and flexibility when it comes to expanding that policy when they feel they need to.
All I got to say is there's so much in this story, and I know you also, Kurt, get into the year it's been for Jack Dorsey dealing with an activist investor, and it's really interesting to see, some of the things that he's been doing at the company. It's a great read, everyone. We'll put it out on Twitter, and definitely check it out. It'll be in the magazine later this week. It's online and on the Bloomberg. It is a great story. There's a really fun story about President Trump, or Donald Trump, the candidate, visiting Twitter offices as well.
It's
and
amazing.
His observations.
It really is. Yeah, it's a terrific piece of reporting. As I said, it's the story we wanted to read about this. As soon as we saw this fracas sort of boil to the surface, just to mix some metaphors there, it was exactly what we wanted. All right, Kurt Wagner, tech reporter for Bloomberg. Check out that story. Our thanks to him and to Joel Weber, editor of Bloomberg Business Week. Much more ahead here on the show. Fed Day. We'll continue to understand how that flowed through the markets, but also some big stories out there, and really looking forward to catching up with Jason Flom. All that ahead. This is Bloomberg Business Week.
This is a Bloomberg Money Minute. The economy may be in recession, but the NASDAQ managed to close above a psychological milestone anyway. 10,000 for the first time on a gain of 67 points to 10,020. After hitting a low in March, this is the fastest 1,000-point gain in 20 years for the average, when it took 49 days to move from 4,000 to 5,000. The Dow fell 1%, 282 points. The S&P 0.5%, 17. Investors had been cheered by word the Federal Reserve would keep interest rates low and support the economy by buying bonds, but they gave back gains when Fed Chair Jay Powell suggested the coronavirus may leave permanent economic damage behind. The coronavirus may mean permanent change at Starbucks. The chain is planning to close about 400 of its traditional coffee cafes and open more pickup stores, smaller ones that have no tables or chairs. I'm Joan Doniger, Bloomberg Radio.
Hi, I'm Danica Patrick. Watching my nieces grow, play, and learn is amazing, but not every child gets to be carefree. 1 in 6 kids in the U.S. are hungry. This breaks my heart, and it's something that Feeding America is working to change. Each year, the Feeding America network of food banks rescues billions of pounds of good food that would have gone to waste and gives it to families in need. To help, visit feedingamerica.org.
Brought to you by Feeding America and the Ad Council.
This July 4th, tune in to the Boston Pops right from your home. For greatest hits, finest moments, guest artists, and a special performance of a stirring salute to America's heroes. From first responders to essential workers, we honor those giving their all in this time of need. A Boston Pops salute to our heroes, presented by Bloomberg and Eaton Vance. Watch and listen from home July 4th, starting at 8 p.m. Eastern, exclusively on Bloomberg Television and Bloomberg Radio. COVID-19.
This is a message from the government about the next stage of controlling coronavirus with NHS Test and Trace. To protect your friends and family, testing and tracing must become a new way of life. If you have symptoms, you need to get a test immediately. Don't leave home for any other reason. If you test positive, we will contact you to trace people who you might have infected. From now on, if you're told you've been exposed to an infected person, you must self-isolate for 14 days. Play your part and do the right thing so we can safely return to a more normal life. Go to nhs.uk or call 119. Stay alert. Control the virus. Save lives.
Want to relive the glory of college football?
Balls over a man, into the end zone.
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship, featuring Clemson and LSU.
There are going to be 2 champions on the field tomorrow night. There's going to be 1 team hold up the trophy.
Race to the 5! Touchdown!
Search classic game replays to listen for free.
Hey, y'all, we're taking the Marty Party to a whole new level with the Marty Smith's America podcast with Gerald McCoy.
I truly believe that Carolina made a mistake letting Cam go. This is not a personal shot at Teddy Bridgewater. This could have been Andy Dalton. This could have been whoever they brought in. Cam has so much left. Somebody's really getting a great one, man. And I don't think people really understand what they're getting.
Search Marty Smith America to listen.
Are you ready for the realest first-hand take of what's happening in the NBA? On their podcast, All the Smoke, former NBA players Matt Barnes and Steven Jackson bring their fiery intensity to the mic, dishing on the latest news and drama from on and off the court without boundaries.
Half man, half amazing. My friend, our brother, Vince Carter, man, welcome to the show.
Yo, what's up, man?
What's up, my brother?
Man,
Search All the Smoke on TuneIn to listen.
Who says you can't have a laugh while getting serious about America's pastime? On the daily podcast Locked On MLB, comedian and baseball fanatic Paul Francis Sullivan talks about each team, each pennant race, and everything else in the game, from rule changes and controversies to baseball cards and stadium food.
For those of you who are not familiar with me or the old show, I love to obsess over baseball. I'm talking baseball over the Super Bowl. We had a TV show in the Division Series during my wedding.
Search Locked On MLB on TuneIn to listen today.
With the NHL season temporarily on ice, now is a good time to catch up on past games.
Bergeron, he scores!
With game replay on TuneIn, you can listen to every power play, slap shot, and goal of the 2019-2020 season so far.
Suter to Cunningham to Fiala. He scores!
And For a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. Avoid close contact with people who are sick. Remember, 6 feet, it's the rule. Stay your distance and always wear a mask while you're out. Avoid close contact with people who are sick. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Broadcasting live to New York, Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes. You are listening to Bloomberg Business Week. Carol Master along with Jason Kelly. A guest that we've been looking forward to talking to. We've really enjoyed talking with venture capitalists, especially over the last 3 months, right? As we see the world go through a lot of stresses, injustices, trying to figure out what life is like after COVID-19 and what changes longer term. So Roger Lee over at Battery Ventures, Jason, he's going to join us with his thoughts.
Yeah, excited to spend some time with him because the venture capital business, always interesting, especially now. We're going to get to that in just a few minutes. But first, let's get to Charlie Pellet. He's got an update on that trade, what went on after the close, and Jay Powell.
All right, I think you covered it all, Jason Kelly. Carol mentioned stresses. Really, that's what was going on in terms of the market activity between roughly 2 o'clock New York time and roughly actually 2:30 New York time when Powell started speaking and the closing bell. Stocks and the dollar fell as investors assessed the Fed's views on the economy. Treasuries rallied. The S&P 500 index did end the session lower after getting whipsawed as Fed Chair Jay Powell suggested the pandemic could inflict longer-lasting damage on the economy, even as the Fed signaled it will keep rates near zero, possibly for years to come. Here's what Powell had to say about the economy in the statement.
The virus and the forceful measures taken to control its spread have induced a sharp decline in economic activity and a surge in job losses. Indicators of spending and production plummeted in April, and the decline in real GDP in the current quarter is likely to be the most severe on record.
Powell's comments carried live right here on Bloomberg Radio, also on Bloomberg Television. S&P ended the day lower by 17 points, down 0.5%. Another record for NASDAQ, up 66 points, up 0.7%. The Dow down 282, a drop there of 1%. Should point out that in the year-to-date column, NASDAQ now up by 11.7%. Briefly, was up more than 12% on the year. 10-year up 28.30 seconds, yield 0.73%. Gold up 1.1%, 17.33 the ounce, and West Texas Intermediate crude up 0.3%, 39.07 a barrel. Tough day for Boeing shares. Member of the Dow down 6.1%. Boeing is targeting late June for a recertification flight on the ground at 737 MAX. It's also notifying airlines of a key fix to the jetliner's wiring in signs that the troubled jetliner is nearing a return to service. Again, Boeing shares tumbled 6.1%. Recapping, equities mixed, lower on this Fed Wednesday. S&P down 17, down 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening to the Wednesday edition of Bloomberg Business Week. Carol Master along with Jason Kelly. Our next guest has invested in Angie's List, Groupon, Hotel Tonight, Trip.com, many more. Some of these companies, ultimately, Jason, were acquired by the likes of Boeing, Airbnb, and many other well-known publicly held companies. Investor and entrepreneur Roger Lee is general partner at Battery Ventures, and he joins us on this Wednesday on the phone in Palo Alto. Roger, great to have you here with us. We've really loved talking to venture capitalists during the last few months in particular, because we feel like our world is changing and trying to get a handle of what really stays with us. Tell us, first of all, a little bit about your life and how it's been going personally, professionally because of the virus and even the activism, of course, over the last couple of weeks.
Sure. Hey, good afternoon, Jason, Carol. Thanks for having me on the show. I will say where I'll start, actually, I love hearing the traffic updates. I grew up back in New York. And I live California now. It's fun to hear all the names of the roads I grew up driving around as a kid. So,
you're like, traffic on the Deegan again? Come on.
Totally. Yeah,
Roger,
funny.
some things never change.
It's true. It's true. Traffic's not as bad these days, though. That's one of the benefits of what's going on these days.
Yeah.
So, life is complicated. I'd say work from home has been pretty stable. School from home is a lot trickier. So I've got 3 young kids. And so navigating all the challenges with schoolwork has been a little complicated. But our work and what we're doing day to day as investors really hasn't shifted that much. We're staying very active, have a bunch of themes we're very excited about. These are themes that we've been investing in a long time, ranging from cloud computing to consumer marketplaces, and believe these are really durable opportunities, kind of pre-COVID and post-COVID. So we're continuing to stay very active and looking for great entrepreneurs building transformative companies. And so we're going to continue to invest even during what are otherwise pretty challenging periods.
And the same types of entrepreneurs sort of coming at you? Is it in the same flow, or what's different about either what you're seeing or who you're seeing, Roger?
Yeah, I'd say that, the one big question a lot of us ask ourselves is, having meetings in person is virtually impossible these days. So are we going to invest in an entrepreneur we've never met in person before? We haven't had to cross that bridge just yet. There are a couple of opportunities we're looking at right now where we are asking ourselves that question. All of the investments we've made since shelter in place have been with companies that we've known for a long time. We've had relationships with the entrepreneurs. They're part of themes we've been investigating for a while. So we haven't had to address that issue just yet. But depending on how long this goes on, there's definitely a scenario where that question will come up, and we'll have to figure it out. But in terms of the makeup and the composition of the entrepreneurs and the themes, that part hasn't changed too much. Again, we tend to be a pretty thematic firm, and so we have a handful of product market spaces we go very deep into and invest in, and we're excited about the themes we've been investing in and the entrepreneurs that are building companies in those categories. So that part hasn't actually changed too much. It's just the way we're doing diligence and how we're interacting with them purely over video. That's been the biggest, probably the biggest shift.
It sticks, right?
So it stinks or it sticks?
Well, depending on the day, it can stink if there's too many of them. No, but it's like it's a little bit of both.
Yeah. Well, we're kind of professional meeting takers. If you look at the calendars of the average investor, we're spending many hours a day, meeting with entrepreneurs, doing diligence on those investments, and so we spend huge portions of our lives just literally sitting in conference rooms meeting with people, and so that part has shifted a lot, and it's hard for sure because there's a belief, and I think there's a lot of logic to this that. You have to develop a relationship. You have to have chemistry with the entrepreneurs you're going to work with, because we're typically in these investments for 8-10 years, if not longer.
Right.
And the only way you can really, relationship and great chemistry with this person. Right. I mean, it's easier to get divorced than it is to get rid of your investor. And so we take these relationships very seriously. We only make a handful of investments every year. Yeah. And so as part of that process... Roger,
I'm going to stop you right there. I'm just going to pause you for 1 second because we're going to do some news. We're going to come back and continue this conversation in just a minute with Roger Lee of Battery Ventures. Let's get to Mark Mills now. He's got some headlines. Hey.
All right, thanks. The number of coronavirus infections in the U.S. has approached 2 million as new hospitalizations in some states, including Texas and California, spark concern of a second wave. Dr. Anthony Fauci, the nation's top infectious disease expert, urges cautions as states reopen.
Everyone wants to approach normality and get things back to normal, including the economy. But that doesn't mean that all bets are off.
Fauci appeared on ABC's Good Morning America. Republicans and Democrats may have trouble agreeing on police reform legislation, but there was a sign of bipartisanship today at a House Judiciary Committee hearing on policing practices and law enforcement accountability. Ranking Committee Republican Jim Jordan of Ohio.
The American people understand it's time for a real discussion, real debate, real solutions about police treatment of African Americans.
The recent protests over George Floyd's death are sparking changes in the entertainment industry, as we hear from Bloomberg's Nathan Hager.
Gone with the Wind is gone from HBO Max. The new streaming service has pulled the Oscar winner, but plans to return it with a denouncement of its racial stereotypes. Cops is canceled from the Paramount Network. The police reality series had been on the air since 1989. Also, the Grammy Awards plan to drop the word urban from their list of categories. And Variety reports Netflix is promoting a new Black Lives Matter collection for U.S. subscribers. It includes 45 titles, including Spike Lee's latest film, Da 5 Bloods. Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Mark Mills. This is Bloomberg.
25 years ago, NJIT graduate Dick Sweeney co-founded Keurig Green Mountain, a company whose incredible innovations changed the way the world brews a cup of coffee. Today, he lectures widely on business leadership and is a strong advocate for NJIT's work to combine business education with the power of STEM.
NJIT is definitely fostering the innovative thinking for budding entrepreneurs simply because that's the world we live in. NJIT is producing students that have been trained, educated, and given the business acumen to be a contributor to a company. The distinct mission is to develop great STEM scholars. The attributes I've always looked for in team members are heart, smarts, guts, and luck. So we want people with passion, intelligence, courage, and never discount luck. The student coming out of NJIT has experienced all of that.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
Asset managers who seize change to launch new strategies, add distribution channels, or exploit new technology to re-engineer the investor experience are often rewarded. However, in an industry paralyzed with complexity, few act with agility or decisively. Few run their businesses strategically, yet the most competitive managers in the market know with the right partner and a flexible operating system, you can. Go boldly toward change with SEI Investment Manager Services.
Determination and operational strength are both essential factors for growth in asset management. I'm Steve Meyer, President and Head of SEI's Investment Manager Services Division. We know that disruptive forces create opportunities around the world. If you see potential in change, our industry specialists will maximize SEI's integrated platform of data and risk management, global investment operations, compliance support, and investor services to position your asset management business for success. Come grow with us.
With SEI Investment Manager Services, you lead the charge in a competitive marketplace. Learn more at seic.com/seize change.
In-depth analysis.
Can my employer change my contract?
Am I entitled to statutory sick pay?
What is holiday pay?
When can I take annual leave?
Is my employer allowed to change the hours I work?
How do I raise an issue with my employer?
Right now, it's important to know your rights in the workplace. At ACAS, we're here to help with free impartial advice. Visit us today at acas.org.uk/rights at work.
Ready to talk brass tacks on what's happening in Major League Baseball? Turn to the Effectively Wild podcast from Fangraphs for daily statistics, analysis, and commentary.
One team will say, yeah, we're going to keep paying minor leaguers their stipend, and another team will say, we're going to extend the stipend through this month, and then another team will say, nope, we're cutting them off. So are extending it at least through August, which would basically be the end of the minor league regular season.
Search Effectively Wild on TuneIn to listen.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
First, we're told that masks don't work. Then, we're told to wear them all the time. One week, we hear that the mortality rate is 2%. The next, well, who knows? In the time of COVID-19, there is so much uncertainty, and so much scientists are learning in real time, along with the rest of the world. So it's hard to know what you can be sure of and what's still a big question mark. Enter Podcast 19 from 538, where we'll explore the evidence behind the science in our fight against coronavirus. I'm science journalist Anna Rothschild. Each week, I'll investigate coronavirus mysteries, keep track of the latest developments on vaccines and treatments. Oh, and I'll try to edit out all the times I shush my family since I'm recording this thing from the chaos of my home.
Search Podcast 19 to listen today.
Looking to freshen up your listening on TuneIn? Head to the homepage to discover something new. There you'll see custom recommendations based on your listening habits, along with new episodes of shows you've enjoyed in the past. Uncover your next audio obsession on the homepage.
Are you fully informed on the NBA? On the NBA Hangtime podcast, veteran sports writers Sekou Smith and John Schumann analyze the latest NBA news, storylines, and discussions with guests from around the basketball universe.
Isaiah Thomas joined us here on the Hangtime podcast. Isaiah, good morning.
Everybody's doing well. As you know, my daughter tested positive.
Search NBA Hangtime on TuneIn to listen.
Buckle up, race fans.
NASCAR is back in the driver's seat.
And you can cut straight to the action here.
With the Performance Racing Network on TuneIn, you can hear PRN's live coverage of some of this year's top events.
As NASCAR's top drivers, Kevin Harvick,
Clint Boyer, and more get back on the track.
Search Performance Racing Network to listen and see upcoming races.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Fed Wednesday, and the Dow, the S&P both declined. NASDAQ advanced again today, up at another record. Volatile session. Bottom line there, stocks whipsawed. The dollar fell, treasuries rallied as investors assess the Fed's views on the U.S. economy. S&P 500 index down 17 to 3190, down 0.5%. NASDAQ up another 66 points, up 0.7%. The Dow slumped 282 points, down 1%. Again, a volatile session. 10-year up 28 30 seconds with a yield of 0.73.